If you stay until the very end of this video, you will not suddenly become rich, but you will stop being poor in the most dangerous way, the way that comes from not understanding the game you are playing. Money is not just currency, it is a language of power, and today you are going to hear its full story in one continuous breath. Think of this video as a map, not to treasure, but to the terrain beneath your feet, the invisible structure deciding who rises and who remains stuck, wondering why effort alone never feels enough. This is not motivation, this is orientation, and orientation changes outcomes. Right now, a generation scrolls endlessly through charts, crypto prices, side hustles, and overnight success stories, believing wealth is something new, something digital, something invented in the last decade. That belief is convenient, but it is false. What you are experiencing today is not a revolution. It is a repetition, wearing better graphics and faster internet. Every financial trend you see on your screen has already happened before, just slower, quieter, and with sharper consequences for those who misunderstood it. To understand money, you do not start with coins or numbers. You start with trust. Around 3,000 years before the Common Era, in ancient Mesopotamia, people were not trading gold. They were recording debts. Clay tablets tracked who owed grain, silver, or labor, and those records mattered more than physical objects. Money was born not as wealth, but as memory, a system designed to remember obligations when humans could not. As societies expanded, trust needed symbols. Metal coins appeared around the 7th century before Christ in Lydia, made of electrum, a natural alloy of gold and silver. These coins worked not because of their shine, but because the state stamped them with authority. From the beginning, money was never neutral. It carried power, enforcement, and the promise that someone stronger would back its value. Empires learned quickly that controlling currency meant controlling behavior. Rome mastered this lesson. At its height, the Roman denarius was trusted across continents. But when emperors began reducing its silver content to fund wars and excess, inflation followed. Prices rose, confidence cracked, and citizens felt poorer without understanding why. The mechanics were invisible, but the pain was real. This was one of the earliest lessons that monetary manipulation always extracts its cost quietly. Then, all at once. After Rome fell, Europe entered centuries where money became scarce, fragmented, and local. Wealth was land, not liquidity. Power belonged to those who controlled resources directly, not abstract systems. But this simplicity did not last. Trade returned, cities grew, and finance reawakened with sharper intelligence. By the 14th century, Italian city-states like Florence and Venice invented modern banking. Double-entry bookkeeping emerged, a quiet revolution that allowed profit, loss, and risk to be measured with precision. For the first time, money could be analyzed, optimized, and scaled. This was not about greed, it was about control. Whoever understood numbers better could predict outcomes earlier than others. Then came a structural shift that changed everything. In 1792, under a buttonwood tree on Wall Street, 24 brokers signed an agreement that would eventually become the New York Stock Exchange. This was not just a marketplace, it was the formalization of speculation. Value was no longer only what something produced, but what others believed it might become. This single idea reshaped capitalism forever. The 19th century industrialized finance alongside factories. Railroads, steel, and oil required capital on a scale no individual could provide. Shares allowed risk to be distributed and ambition to expand beyond personal limits. But with expansion came volatility. Financial cycles emerged, booms followed by crashes, hope followed by collapse. The system was growing faster than humans could predict. The first global financial collapse arrived in 1873, triggered by railroad speculation and bank failures. It spread across Europe and the United States, lasting years. Governments were unprepared, central banks were weak, and ordinary people paid the price. This pattern would repeat again and again, each time with new language but identical mechanics. Then came 1929. The stock market crash was not caused by a single event, but by excessive leverage, speculative frenzy, and blind faith in endless growth. When confidence broke, the system collapsed inward. By 1933, unemployment in the United States reached approximately 25%. Money vanished not because it was destroyed, but because trust evaporated. The response to this crisis quietly redefined modern finance. Governments stepped in, markets were regulated, and central banks gained unprecedented power. In 1944, as World War II neared its end, the Bretton Woods Agreement established the US dollar as the world's reserve currency, backed by gold at $35 per ounce. Stability returned, but at a cost. Monetary power consolidated. For decades, this system held. Growth felt natural, predictable, almost permanent. But stability creates complacency. In 1971, President Richard Nixon suspended the dollar's convertibility to gold. With one announcement, money became fully abstract. Currency was no longer tied to physical scarcity, only to policy decisions and collective belief. This was the moment money became psychological. Inflation surged in the 1970s. Interest rates climbed above 15% in the early 1980s. Debt expanded, markets globalized, and finance accelerated beyond national borders. Complexity replaced transparency. Speed replaced comprehension. By the late 20th century, capital moved faster than regulation. Derivatives multiplied, leverage hid inside balance sheets, and risk was disguised as innovation. In 2008, the illusion broke. The global financial crisis erased trillions in value. Major banks collapsed or were rescued. Ordinary people lost homes, savings, and years of progress, while the system itself was stabilized at the top. This was not a failure of capitalism. It was a revelation of its design. Losses were socialized, gains remained private, and the cycle reset. Central banks responded with near-zero interest rates and unprecedented money creation. Quantitative easing became normal. Asset prices rose. Inequality widened. Those closest to capital recovered first. Then came a new narrative. Crypto promised decentralization. Meme stocks promised rebellion. Hustle culture promised escape. But beneath the surface, the structure remained unchanged. Liquidity flows upward. Volatility transfers wealth from the impatient to the disciplined. Information remains asymmetric. Money today is faster, louder, and more accessible than ever, but it is not more forgiving. The system does not punish ignorance immediately. It rewards confidence first, then collects the bill later. Understanding history does not guarantee wealth, but ignorance guarantees vulnerability. This is where the story pauses, not ends, because the final truth about money is not found in charts or headlines, but in behavior, incentives, and power structures that never announce themselves. In the next part, we will dissect how modern finance quietly shapes your decisions, your risks, and your future, even when you believe you are acting freely. If Part 1 explained how money was built, this part explains how it controls without appearing to touch you. Modern finance no longer needs force or chains. It operates through incentives, defaults, and quiet pressure, shaping behavior while preserving the illusion of choice. Most people believe they are making financial decisions freely, But freedom inside a system is not the same as freedom from the system. At the center of modern money sits debt, not as a problem, but as a design feature. Governments issue bonds, corporations borrow to expand, and individuals finance homes, education, and lifestyles before earning them. Debt pulls the future into the present and charges interest for the privilege. This single mechanism accelerates growth, but it also locks behavior into long-term obedience. When debt expands faster than income, dependency forms. This is not accidental. After 1971, when money became untethered from gold, credit could expand without physical limits. Banks were no longer constrained by reserves in the same way. Money became elastic, stretching to meet political and economic demands. Growth was maintained, but stability quietly eroded. Central banks emerged as the invisible governors of this system. By adjusting interest rates, they influence borrowing, spending, hiring, and risk-taking. When rates are low, money feels cheap. People invest, speculate, and consume. When rates rise, activity slows. Jobs disappear. Assets reprice. These shifts are described as policy, but they function as behavioral signals. The average person does not watch bond yields or liquidity flows. They feel the outcome instead. Rent rises. Mortgages become expensive. Credit card balances grow heavier. The system does not need to explain itself to operate effectively. Complexity itself acts as camouflage. After the 2008 crisis, central banks crossed a threshold that was never reversed. Trillions of dollars were created digitally to stabilize markets. This money did not enter the economy evenly. It flowed first into financial institutions, then into assets, then into prices. Stocks recovered quickly. Real estate surged. Wages lagged behind. This divergence created a structural split. Those who owned assets felt richer. Those who relied on labor felt pressure. Inflation was not immediately visible in consumer goods, but it accumulated quietly in housing, education, and healthcare. Wealth inequality widened not because of effort differences, but because of proximity to capital. For a generation coming of age after 2010, the rules felt broken. Hard work no longer guaranteed security. Saving felt pointless when asset prices outpaced income. This psychological gap fueled alternative narratives. Crypto promised escape from centralized control. Meme stocks promised revenge against institutions. Hustle culture promised individual sovereignty. But systems do not collapse because of narratives. They absorb them. Speculation became gamified. Risk was reframed as empowerment. Losses were internalized as personal failure rather than structural exposure. The system adapted faster than its critics. What most participants miss is that volatility is not a flaw, it is a transfer mechanism. Rapid price movement rewards those with time, capital, and emotional distance. It punishes those who react. Fear and excitement become extraction tools. This is why financial markets are saturated with noise. Noise creates motion. Motion creates mistakes. Debt amplifies this effect. When obligations exist, patience disappears. Decisions compress. People sell at the worst moments not because they are irrational, but because they are constrained. Leverage removes optionality. Optionality is where power lives. The modern economy also runs on consumption narratives. It requires spending. Spending requires belief. Advertising, social media, and algorithmic feeds normalize lifestyles that exceed median income. Credit fills the gap. The result is a population permanently chasing a moving baseline of normal. This is not accidental manipulation. It is structural momentum. Systems optimize for continuation, not well-being. As long as debt is serviced and growth metrics hold, strain is treated as external noise. Technology accelerated this dynamic. Trading apps removed friction. Payments became invisible. Buy now, pay later normalized future obligation as present comfort. Financial decisions lost emotional weight. When consequences feel distant, risk-taking increases. At the same time, data became the new collateral. Behavioral patterns are tracked, predicted, and monetized. Creditworthiness is no longer just income, it is predictability. The more consistent your behavior, the easier you are to price. The easier you are to price, the easier you are to manage. This is where money intersects with control. Not through prohibition, but through optimization. People are nudged, not forced, incentivized, not commanded. The system rewards compliance with convenience. Yet, within this structure, leverage still exists for those who see clearly. Financial history does not repeat because people forget facts. It repeats because incentives remain unchanged. Understanding the cycle does not grant immunity, but it restores timing. Those who build resilience focus less on prediction and more on positioning. Liquidity becomes safety. Low fixed costs become freedom. Optionality becomes power. These are not slogans. They are structural advantages. The most dangerous belief in modern finance is that someone is coming to fix it. Systems adjust under pressure, but they do not reverse. Every intervention creates second-order effects. Every rescue teaches future risk-takers that losses may be absorbed elsewhere. This does not mean collapse is inevitable. It means volatility is permanent. Stability, when it appears, is temporary and often artificial. The calm before disruption is when leverage accumulates. For individuals, the question is not how to beat the system, but how to stop being silently taxed by misunderstanding it. Inflation is a tax on cash. Complexity is a tax on attention. Speed is a tax on patience. The final illusion to discard is fairness. Markets do not reward virtue. They reward positioning. They do not punish greed. They punish poor timing. Moral narratives obscure mechanical reality. When you understand money as a system of incentives rather than a moral scoreboard, clarity emerges. You stop chasing signals. You stop reacting to noise. You start observing flows. This is the quiet advantage history offers. Not certainty, but perspective. Those who survive cycles are rarely the loudest. They are the ones who recognize patterns early and act without drama. In the final part, we will compress everything into one principle: how power concentrates, how cycles reset, and how individuals who understand structure move differently through uncertainty. Not to escape the system, but to stop being crushed by it. If the first part revealed how money was built, and the second showed how it quietly governs behavior, this final part answers the only question that matters. Where does power actually settle after every boom, every collapse, every rescue, every reset? The answer is uncomfortable because it has never changed. Power concentrates where optionality survives stress. Financial history does not move in straight lines. It moves in compressions. Periods of stability invite leverage. Leverage invites fragility. Fragility demands intervention. Intervention resets the system at a higher level of complexity, but with the same underlying incentives. Each cycle feels new only to those encountering it for the first time. Empires, currencies, and institutions rise not because they are fair, but because they manage risk better than their competitors. When risk is misunderstood, it migrates downward. When risk is understood, it is priced upward. This is the invisible sorting mechanism beneath every financial era. Throughout history, the winners of cycles were not those who predicted collapse accurately, but those who remained solvent long enough to act when others could not. Liquidity is not idle capital. It is delayed power. It allows patience in moments when urgency forces mistakes. Most people assume wealth comes from boldness. History suggests it comes from asymmetry, the ability to say no when others must say yes, the ability to wait when others must act, the ability to absorb volatility rather than react to it. This is why concentration accelerates after crises. During stress, assets move from weak hands to strong balance sheets, from individuals to institutions, from emotion to structure. This is not conspiracy. It is math combined with human psychology. The modern world disguises this transfer with narratives of opportunity. Access replaces ownership. Participation replaces control. Being involved feels like power, but it is not the same as holding leverage. Leverage exists only where consequences can be delayed. The most important financial divide is not between rich and poor. It is between those who can absorb time and those who cannot. Time pressure collapses decision quality. It converts small mistakes into permanent damage. Cycles end not when systems break, but when belief breaks. Confidence is the fuel. When confidence is high, risk hides. When confidence cracks, risk reveals itself everywhere at once. This is why reversals feel sudden. They are not sudden. They are synchronized. Every generation believes it is living through unprecedented complexity. Every generation is correct about the complexity and wrong about the novelty. Tools change. Speed changes. Human behavior does not. Fear, greed, imitation, and denial operate the same way whether prices are written on clay tablets or glowing screens. The system scales these emotions. It does not remove them. The final illusion to release is the idea that financial systems exist to serve individuals. They exist to preserve continuity. Stability is pursued not for fairness, but for predictability. When predictability is threatened, intervention follows. This explains why moral outrage rarely changes outcomes. Systems respond to incentives, not emotion. Complaints do not alter structure. Positioning does. Understanding this does not require cynicism. It requires clarity. Once you stop expecting fairness, you stop being surprised by outcomes. Surprise is expensive. Preparation is not. The individuals who navigate cycles successfully tend to share quiet traits. They avoid maximum leverage. They resist urgency. They build buffers others see as inefficiency. They treat liquidity as insurance, not missed opportunity. They also understand that not every opportunity must be taken. Missing upside is survivable. Forced exits are not. Survival compounds. The system rewards those who align with its mechanics rather than fight its narratives. This does not mean obedience. It means fluency. Fluency allows selective participation. Money, at its core, is a coordination tool. It aligns effort, belief, and timing across massive populations. Those who understand its language are not immune to loss, but they lose on their own terms. This is the final synthesis of financial history. Wealth is not stored in assets alone. It is stored in flexibility. Power is not loud. It is patient. When you zoom out far enough, the message becomes simple, but not easy. Control what you can. Reduce fragility. Increase optionality. Let time work for you, not against you. This is not advice for quick riches. It is insulation against predictable mistakes. The system does not need you to fail. It only needs you to misjudge timing. Once you see money not as a goal, but as a structure moving around you, behavior changes naturally. You stop chasing peaks. You stop fearing corrections. You start thinking in cycles instead of moments. That shift alone separates spectators from participants and participants from survivors. The promise at the beginning was never about sudden wealth. It was about orientation, knowing where you stand, what moves around you, and which forces are real. History does not give guarantees. It gives warnings. Those who listen early do not look smarter. They simply look calmer when others are loud. And in finance, calm is not a personality trait. It is a position.